Hello and welcome to our weekly Understanding Markets webinar. We're recording this in the afternoon of Tuesday, the 29th of March. I'm Hellen Dalton. I'm a Senior Investment Manager with Cantor Fitzgerald, and I am joined once again by our illustrious Chief Investment Officer, David Beaton. Hello, David, and I think it's been nearly a month, well, just over a month since the invasion began in Ukraine. Where are markets now?
Well, it's interesting, Helen, when you look at kind of the depths of the markets when we had the first one of these kind of podcasts 2 or 3 weeks ago. We were trading near the bottom of the ranges for all markets. It was very much risk off. Oil prices had gone through the roof. Obviously, inflation concerns were first and foremost in everyone's minds as a result of the invasion, and also as well in the background we had the uncertainty about global central bank policy. But if we just take markets as of a couple of hours ago, since the 23rd of February, which was the last day before the invasion commenced, European markets were pretty much flat, so they've recouped all their kind of geopolitical declines, and US markets are actually up between 5% for the Dow and up over 11% for the Nasdaq. So we've seen a very strong return to kind of risk assets over the course of the last month, notwithstanding the ongoing uncertainties that still continue in Ukraine. But I specifically mentioned the performance of markets when I checked them a couple of hours ago, and since a couple of hours ago, while we were preparing for this podcast, we've had some pretty significant developments on potential progress on the peace talks that are currently ongoing in Turkey between Russia and Ukraine. The word coming out appears to be, and you know, the US are also seem to be verifying these reports that progress has been made, that there is a move, however real it may turn out to be, that the Russians are actually scaling down some of their military activity, particularly around Kyiv. So certainly progress appears to have been made, and reports suggest as well that these talks will continue later into today and possibly into this evening. So that's incrementally very positive news, and as a result we've seen equity markets in Europe rebound by over 3% today alone. So we're now up since the invasion on the 23rd. Oil prices, which had been really in focus for equity markets and equity investors, they're down about 6% on the back of this news. So all in all, a much better tone to things at the moment.
Yep, and I certainly just an exact example of how quickly these markets are moving, oil falling by over 5% so far on that news. And I think one of the things we've seen over the last month or so is the strength of the US market over Europe for very obvious reasons. Are you seeing a reversal of that and maybe a trend back towards Europe?
Yeah, I think once we see some incrementally positive news on the geopolitical side, clearly, because of obviously the proximity of kind of the NATO alliance, European countries to Ukraine, any sort of positive news there was always going to be somewhat helpful for sentiment towards European risk assets. US markets had outperformed from the lows that we saw in around the first or second week of March. They'd outperformed European equities, and it was a point we highlighted in one of our podcasts that we did anticipate that would be the case. But you know, the other important factor for Europe and why European markets are starting to maybe see some attraction and inflows is the fact that oil has come back down towards that $100 a barrel mark. Clearly, Europe is incredibly dependent on Russian oil, and while they haven't moved to embargo Russian oil supplies, they are scrambling like mad to try and find alternative sources, such as the deal they did with the US on the liquid petroleum gas side of things. So, things like that are clearly positive for sentiment for European equities. We've also seen the euro rally in the course of the last couple of hours on the back of this news. The euro had been under pressure. It had got down to about 109 against the dollar, but we're now back up near 111. So again, that's indicative of a flight of money into the European area, overseas investors buying European assets and being forced to fund that through buying euros.
Indeed, thanks very much. And another thing that has been preying on investors' minds is, of course, inflation, which is showing no signs of being alleviated at the moment. One of the causes, of course, is bottlenecks in the supply chain. How are companies responding, and what might this mean in the medium term for companies?
Well, I think companies are managing to adapt and cope to the supply chain issues. We certainly appear to have reached a peak in the supply chain disruption issue. If you look at something as anecdotal as Nike's results last week, who had been facing very severe supply chain disruptions out of its manufacturing plants in Vietnam, they reported very strong results last week. It's a stock that we like here in Cantor, and one of the reasons why we like it is the positive communication they gave on the easing of supply chain bottlenecks from their side of things. So we're starting to see incrementally companies coming out saying that the difficulties they were encountering because of kind of the lockdowns and the disruption caused by that, particularly in Asia during the course of 2021, is starting to ameliorate a little bit. We saw NVIDIA as well last week in the semiconductor space also give a more positive outlook in relation to what it's seeing in relation to the supply of the raw materials for semiconductor manufacturers. So yeah, certainly things have improved. We're not out of the woods yet, though, on that. Obviously, the lockdown in Shanghai over the course of the last couple of days with the re-emergence of the new strain of COVID may create some short-term disruption to the improvement in the supply chain, but certainly things are improving incrementally from where we were maybe 6 or 7 months ago.
That is good news all around. And of course, I just wanted to say congratulations, a great recommendation from you and the team with Hibernia REIT, which is being taken out as announced last Friday. Where are we advising clients to put the proceeds?
Yeah, well, it was a good call I won't take all the credit for it, but certainly myself and the research team had been advocating Hibernia REIT for quite some time because of the discount it was trading at to its net asset value, to the very attractive dividend yield that it was distributing because of its real estate investment trust structure. So that's been a really good positive for our clients. So for any clients who have actually sold into this strength in the share price in Hibernia REIT rather than waiting for the formal takeover, which probably won't be until the second quarter of this year, we'd be looking at some similar type of stocks that are good replacements from a yield perspective, the likes of Supermarket Income REIT. We've mentioned that before here. It's a property real estate investment trust in the UK that leases out properties to all the major supermarkets in the UK. And given the nature of its business, it is very much inflation proofed because the leases will move in tandem with inflationary pressures. And that's also giving a yield of about 4.7, 4.8%. Another one that we like, similar it's in the property space in a totally different area compared to Hibernia REIT, is Cairn Homes, the Irish home developer. It's reported a very strong update there about a month ago, looking to increase the number of units that it's going to bring to market over the course of the next 12 months. Very strong in a capital position and also paying a very attractive dividend yield of about 4.5%. So there are two alternatives that clients coming out of Hibernia REIT might want to consider.
Excellent. Thank you so much. And I did notice we were also mentioning Volkswagen in our daily note this morning, maybe for some of the higher risk investors out there. Wonderful. Thank you again, David. We really appreciate your time. And just A quick word to any clients out there interested in investing at the moment. Do have a word with your broker. Markets are moving very rapidly at the moment. News is breaking as we're talking. So we would urge you to have a chat and get in touch. Many thanks and goodbye.